Welcome to The Explainer. Today we're doing more than just summarizing Warren Buffett's 2018 shareholder letter. We're actually breaking it down and turning it into a practical playbook for professional investors, really cutting through the noise to get to the core principles from one of the greatest capital allocators of all time.
Okay, let's just jump right in with the only number you really need to see to understand why any of this matters. From 1964 to 2018, Berkshire Hathaway's market value posted an overall gain of nearly 2.5 million%. No, that is not a typo. It absolutely dwarfs the S&P 500's return, which was about 15,000% over that same stretch. This isn't just a track record, it's a testament to a very specific and very durable philosophy.
So, the big question is, how did he do it? Well, we've broken the letter down into 6 key areas. We're going to start with his new way of keeping score. Then we'll dive into how he sees right through all the accounting noise. After that, we'll get into his valuation framework, the absolute power of insurance float, and his core philosophy. And then we'll wrap it all up with the key takeaways for your own investment process.
First up, let's talk about a really fundamental shift that Buffett announced. For decades, he started his letters with one key metric, but in 2018, he officially changed the game. He's moving away from book value. So why the change? Well, simply put, it's just lost its relevance. See, Berkshire isn't just a collection of stocks anymore. It's now dominated by these massive operating businesses whose real worth is just plain understated on the balance sheet. Plus, as Berkshire buys back its own shares above book value, the metric itself becomes, and this is in his own words, increasingly out of touch with economic reality. The big lesson here? As a business evolves, the scorecard you use to judge it has to evolve too.
All right, next. The playbook shows us how to filter out all that noise that's just baked into modern financial reporting. And this is an absolutely critical skill for any serious analyst.
Buffett uses this brilliant quote from Lincoln to completely dismantle a metric that, let's be honest, we all see every single day: adjusted EBITDA. He's basically arguing that it's just an attempt to redefine what earnings are by excluding costs that are very, very real. And he points directly to a new GAAP rule that actually forced Berkshire to report these wild quarterly swings, including, get this, a staggering $25.4 billion loss in one quarter. But here's the reality. While those GAAP numbers were just all over the map, their actual operating earnings were consistently strong. In fact, they grew 41% over their 2016 high. So the crucial point is this: a lot of Wall Street's adjustments often hide more than they reveal. Stock-based compensation, that's not some kind of gift, it's a real expense. And those restructuring costs, they're not some rare surprise. For a lot of businesses, they're pretty common. A professional investor's job is to look right past these fictions and focus on the real, durable earning power of the business.
Okay, let's dive into the core valuation framework from the letter. This is really a masterclass in how to analyze a complex business like a conglomerate without just getting completely lost in the weeds. So instead of trying to value every single company Berkshire owns, which would be a nightmare, Buffett simplifies the entire enterprise into 5 groves. You've got the operating businesses, the big stock portfolio, some shared control ventures, cash, and of course the insurance operations. He argues that you can appraise each of these with reasonable accuracy, and that gives you this powerful, high-level view of the entire forest.
And this just brilliantly illustrates a key insight, especially from that second grove, the stock portfolio. So for 8 years, Berkshire's holdings of American Express shares stayed exactly the same. But their ownership stake, that grew from 12.6% to 17.9%. How? It was simply because Amex used its own retained earnings to buy back its stock. So Berkshire's slice of the profits grew massively without them investing a single extra dollar. It is such a powerful lesson in the value that capital-efficient management teams can create.
Now let's move on to that 5th growth, which Buffett calls the engine that has propelled Berkshire growth for decades. Honestly, this is the secret sauce. At the very heart of this engine is something called insurance float. Basically, this is the capital that Berkshire gets to hold because it collects premiums up front, but it only pays out claims much later. It's an incredibly powerful source of leverage, right? It provides this permanent, very low-cost pool of capital that they can then go out and invest. Now, what's just so wild about this is the sheer scale of the growth. Look at this. It went from just $39 million back in 1970 to over $122 billion by 2018.
This isn't just some funding source, it's a tidal wave of capital that fuels the entire Berkshire enterprise. And here is the kicker. Thanks to really disciplined underwriting, Berkshire has actually earned a $27 billion pre-tax profit from its insurance operations over the last 16 years. So think about that. This massive $122 billion float wasn't just free money. They literally got paid to hold it. For any investor, understanding where a company's funding comes from is critical. And this is pretty much the holy grail.
So all of this brings us to the ultimate philosophy that underpins the entire playbook. All the analysis, all the financial strength. It's all built on this profound belief in long-term American prosperity. Buffett makes just a stunningly clear case here with his own first investment back in 1942. That $114 he put into a simple S&P 500 index fund would have grown to over $600,000. The exact same amount put into the supposed safe haven of gold, that would be worth just $4,200. The magical metal was just no match for American metal.
And he argues that it is beyond arrogant for any American business to claim they did it alone. He gives credit to this powerful collective force of innovation, productivity, and enterprise for so much of their success. It's a really good reminder to bet on the system, not just a single stock.
And he directly takes on a really common fear. Over that same 77-year period, the U.S. national debt increased by 40,000%. Now, while a lot of people panicked about deficits and currency collapse, the underlying dynamism of American business just kept delivering, proving that the engine of enterprise is way more powerful than the headwinds of government debt. So how can we, as professional investors, actually apply this playbook today? What are the really actionable principles that we can pull from this letter?
The playbook is really clear. First, focus on economic reality, not accounting reports. Use a framework like the 5 Groves to value the whole business. Really understand and appreciate the power of durable, low-cost funding like float. Demand a fortress-like balance sheet. And finally, just maintain an unwavering long-term perspective that harnesses those powerful tailwinds of enterprise.
And we'll just leave you with this final thought. Buffett's entire letter is really a testament to a process that is built for the long haul. So the question for every single one of us is this: is your own process built to harness that same long-term tailwind, or is it just designed to react to the unpredictable, short-term weather of the market? The answer to that question might just be everything.